back on the set with us. Really
Yes.
appreciate it, man.
No,
You were
thank
on.
you guys for having me again.
Oh man, no question about you. You
Yeah,
come back as
definitely.
often as you would like,
Hmm.
and time permits, because we love the information. The audience love the information that you disseminate, and I love the way you break it down. I've been in the business over 25 years, and I've learned something from listening to you as well. So thank you. And ladies and gentlemen, we were
Absolutely.
talking last week, if you recall, and we have many listeners. I want to thank our listener audience as well, because this show is growing, and it's getting increasingly popular here. Increasingly popular. So thank you, thank you, thank you. And please share with your friends. And I would advise, if you have young ones around, sit them around the radio, or go on Facebook or LinkedIn or YouTube and let them listen also. I think it's a good idea to start teaching our young people about the value of money, the saving money, investing, into their future. I think this is the time to do it. So I let them know that they have another classroom here on Tuesday, another classroom. Okay, they can take notes and things of that nature. I want to start off with this. I recall when I was in Southern California, I used to go around Oscar and Aaron. I used to go around to public schools. I would talk to middle school children. I've even gone to elementary school classes and high school, even colleges, and I would talk to them about the value of money. I would talk to them about investing into their future, and I would tell them one thing. And Oscar, I want you to take over from here. I would tell them the best time to save for you or start your retirement is when you get your first job. I don't care whether it's a McDonald's or Burger King or car wash or whatever it is. I think that is the best time to start. And I want you to take it over from there and give us a recap of what we talked about last week.
Hey, when before I interject, our fun fact. We're getting our fun
Oh,
fact.
that's right. I forgot the fun fact.
Yeah, fun
Okay,
fact.
got to have the fun fact. Thank you,
Okay.
thank you.
Just,
Okay,
just briefly.
now take your time.
Okay. Maggie, Lena Walker, Maggie Walker. A lot of people in Richmond, Virginia, had heard of her, at least heard of her. So Maggie Walker was the first Black woman who owned a bank, who started her own bank, and she was born in 1864 in Richmond, Virginia, and she started the St. Luke Penny Savings Bank in Richmond, Virginia, in the 1800s. So late 1800s. So she became first millionaire, first Black woman millionaire back in those days, and she was also real active in her community and dealing with women's rights as well as African American rights as well. So Maggie Walker, and if you're in Richmond, Virginia, like me and Will in Richmond, Virginia, we're born and raised here. We're born and raised here. We have several, like the school, Maggie Walker. You're alumni. Mr.
That's
Will.
right.
Right. Yeah, you're alumni,
Mighty,
Maggie
Mighty
Walker.
Green Dragons.
Right.
Absolutely. Oh yes, yes, yes. I'm a proud alumni of Maggie Walker High School. Absolutely.
Yeah. So that's our fun fact, Maggie Walker. And a lot of people around the country, may have heard of her, but not really know. And even Richmond, Virginia, unfortunately, we get in the kind of way of who she was. Big pioneer of the Jackson Ward neighborhood, which is we talked on several shows about. That was one of the Black Wall Streets. One of Black
Absolutely.
Wall Street. So Jackson Ward is still here in Richmond, Virginia, and not as powerful, but you have still some economics in that area. So
Absolutely.
yeah, so Maggie Walker, fun fact.
Yeah, thank you so much for that. Thank you. Now, correct me if I'm wrong, but I think there's a museum also in the area, isn't it?
Yeah,
Is it a
so
museum?
yeah. So in 1979, they made her actual home a national museum.
Absolutely.
So her actual home is on Lee Street, on East Lee Street, her actual home. And it's actually set up like what she had it in the 1800s.
Outstanding. Thank you so much for that. Thank you. Thank you.
Wow.
I'm glad you interrupted me.
Yeah.
No, that's
Okay,
okay. That's
there go
okay. No,
Oscar.
Oscar. Yes, thank you, Oscar, again. So, man, Let's start with that. With what, like I said, I believe in talking to our young adults about the importance of finance, the importance of insurance, the importance of investing into their future. And then I want you to maybe speak on that a little bit, and then let's get into a recap of what we covered last week.
Absolutely. And I'm glad you brought that up. I actually had an opportunity to also uh, be a speaker at an event last week where I addressed a lot of individuals that were in their 40s and 50s for the most part. So getting close
Hmm.
to retirement, and we're talking about a lot of the things that we do in the financial industry, how we're able to help them maximize their retirement, lower their taxes, provide a lifetime income, leaving a financial legacy behind. But I also gave them some tips that I want to share with everybody that's listening right now, because I think this would be very helpful, because the tips were really focused on if you are in your 40s or 50s, and it doesn't necessarily only have to be 40s or 50s, but if you feel like you're falling a little bit behind, what are some of the things that you can do to get you on track, to make
Hmm.
sure that you're moving in the right direction? And these are the 5 tips that I gave during that speaking event. And I received a lot of good feedback from it. So if Will and Aaron, if it's okay with you, I'll share what those 5 tips are. And I would love to hear what you think
Yeah.
about
Please do.
these lists.
I have my pen and paper. I'm writing this down.
Excellent, excellent. So the first thing that we want to do, again, if you're falling behind, this is very important. If you're falling behind as you're getting close to retirement, number one, you have to get rid of your fixed rate and broke mentality. That's going to be a difficult one for a lot of us, because for some of us it's very psychological, because it really depends on um, how you were raised. And this goes back to what you were saying earlier, Will, about teaching our children about money early on. Well, sometimes when us adults, when we're having a hard time ourselves with money, it's hard to show our kids the difficulty of how to invest and how to save more money when you're barely trying to get by and you're living paycheck to paycheck. That's a tough position to be in. I got to tell you, when I talk to my clients and I ask them the question, as we're going through a fact find or a discovery appointment, right, where I first get to know them, they get to know me, we find out if it makes sense for us to work together. I ask the question, what's one of the most difficult memories you have in regards to money growing up? And I listen very carefully to what they're saying, and a lot of times it has to do with their parents, um, living paycheck to paycheck, having to move from their home to an apartment because they came across some hardships, because the parents made some bad investments, because they lost their job, because a parent passed away. I hear those stories, and when a child grows up in this way, sometimes it's very hard to get away from that broke mentality. And even more when they start earning some income, start making some money. And what's the first thing that they want to do? Because they came from that mentality of, you know what, we didn't have a lot growing up. I remember being the kid that had to go to Payless to buy my shoes while I see my friends are wearing Jordans and all these other things. So what happens when I start making some money? That money burns in my pocket, and I have to go out there and buy useless things that do not appreciate in value, because it
Mhm.
makes me feel good, because it gives me an adrenaline to my soul, to a certain extent, that hey, I made it. I'm buying all these different things, but I'm not realizing that I'm actually hurting my future self, because I'm not
Mhm.
saving that money. I'm getting rid of it as soon as possible, because I'm out there trying to spend this money to show these people that don't know me that I'm financially doing well, when in reality they could care what they could care about. They don't care about my future. They don't care about where I'm going in life. Maybe I'm trying to impress them, but at the same time, they're probably talking behind my back. That's something common that happens to a lot of us, because we're out there trying to put this facade that we made it, but in reality we didn't. Right?
Mhm.
Commonly, you see the very, very wealthy don't show that they have money. They
Mhm.
live a more modest life.
Mhm.
So, going back to number one, getting rid of that fixed rate and broke mentality, yes, it can be very difficult. That's something that you do need to overcome. What are some ways that you can try and overcome it, that you can do yourself? First of all, watching the show.
Mm,
If you're
I
watching
like
this
that.
show, it's because you're trying to educate yourself and learn more about what's out there. What financial advice can you get? What are things that you can do to do better for yourself, to do better for you and your spouse, to do better for your children and the next generation and the next generation? You can learn a lot from this show, but also there's a lot of great financial books out there that I highly, highly recommend. Will, Aaron, what I'm going to suggest is for the viewers that are watching this episode, if any of them are interested in any of the books that I would recommend, I'm going to encourage them to reach out to you, and
Mhm.
I'll get you guys my list of my top 5 financial books that I've read that really made an impact in my life. And I'm sure Will, Aaron, I'm sure you guys have your own books that you might want to recommend. But that's the number one. You got to get rid of this fixed rate broke mentality. Fixed rate that the banks, I'm going to put all my money in the banks when in reality, your money's not earning that much. It's not.
That's fair.
You're feeling that your money is better protected in your Wells Fargo and your Bank of America at your Chase. It's not. That money's not working hard for you. It's hardly working.
It is.
So again, number one, get rid of your fixed rate broke mentality. Number two, you have to budget aggressively. You have to budget aggressively. You have to cut down on unnecessary expenses that you're being held down with. Many times we sign up to all these different subscriptions online and on our smartphones, and we forget about them, and we then later realize that we're paying $50 a year for a subscription that we don't even use. We forgot all about. There are apps out there that will help you uncover all these unnecessary expenses that are really unnecessary to you. But also, there's all these different software programs out there where you can plug in your spending habits and find out how you can more aggressively budget for your future. I know it's not going to be a fun task, but I promise you this: you'll be much better out if you do it, and your future self will be thanking you. I promise you that. You just got to budget. I'm not saying you can't go out there and have a great time and live life and go out there and go to your favorite concert, go out there, listen to some good jazz, go out there and go to a nice dinner. No, you can still do that. It's a matter of budgeting correctly in order to do that. And the reality for some of us, we need to increase our earned income, even if it requires us to get an additional hustle, another job. Find something else that can give us more income, because if you are living paycheck to paycheck and based on your comfort zone where you're working at right now, you're earning, let's call it $60,000 a year. But again, you got all these expenses. First of all, if you budget, you're going to realize that $60,000 is going to go a lot further. But you're also going to realize you earning $60,000 a year is not going to get you to where you want to be in the very near future. So you have to sometimes, if the reality is that it's going to be difficult for you to leave your current job, if it's going to be difficult for you to ask for that raise, you have to get another side job that, first of all, that you find some joy in it, because you also have to be thinking about your mental health, right?
Right.
But you got to find something else that can help you earn some additional income. And that's a reality for some of us, right? So that's number two. You have to budget aggressively. Number three is you have to build an emergency fund as soon as possible. And I would recommend that emergency fund being a high yield savings account. When I say a high yield savings account, again, that does not mean going to your local bank to put that money in there. That does not mean to put that money under the mattress. There are other accounts that are safe, that are backed up, where you can go ahead and put some money away in case of an emergency, and you can easily get access to it if something does come up. But you have to have that discipline still, that not everything is an emergency. There are some things that you can do without. There are some things where you should maybe leverage your credit card. You got to be very careful with that emergency money, that emergency account, because that's what you're going to need if it really hits the fan. I mean, you lost your job. I mean, there's a death in the family. Whatever the major emergency is, a health condition that your health insurance is not covering. That's what the emergency fund is for. Because if it's an emergency, granted, you're already under a lot of stress.
Right.
What you're trying to avoid for yourself is being under additional mental stress, because you didn't financially put yourself as a priority by having this emergency fund.
Mm-hmm.
So that's number 3. Number 4 is you do have to invest in a Roth IRA as soon as possible, a Roth IRA. These Roth
Mm-hmm.
IRAs are specifically built to help you better prepare for your future, for your own retirement. Hopefully, if you are employed with a company, a corporation of some sort, that they're offering you a 401k plan. Maybe you're an educator, so you have a 403b plan. You're investing in that. And I strongly encourage you, if that employer is offering any type of match, that the bare minimum you match it. But you have to be very careful because it's still an investment, and a good portion of that money could be in securities. So there's risk there. But where there's risk, there's also reward. Where there's reward, there's risk. So you have to keep an eye on it on a periodic basis to make sure that you're doing very well. You know, one month you're at $160,000 saved in your 401k. And the next month, presidential election ended, regardless of who won. Next thing you notice, your 160,000 went down to 120,000.
Mm-hmm.
Mm-hmm.
And what's really scary is that you were planning to retire next year. How is that going to happen? You just lost a big chunk of your retirement money, right? Then the real estate bubble hits, and a lot of the equity in your home just went down. Now you put yourself in a very tough position. So by you taking the initiative to invest in other things, such as a Roth IRA, for most of us, depending on our age, this year you could do about $7,000. That's giving you some additional leeway, some additional comfort that you are putting money away for your retirement, which is going to put you in a better position. So when you're ready to retire, you have your 401k or a pension or your 403b or other type of savings retirement account. You may or may not have Social Security, depending on what happens with Social Security. But now you have this additional account that's specifically tied to your retirement, a Roth IRA. So that's why I recommend that you invest in one. So that's number 4, a Roth IRA.
Mm-hmm.
You might be saying, Oscar, well, I have an IRA. Is that okay? Yeah, it could be okay. But
Mm-hmm.
if you really want to understand the difference between an IRA or a Roth IRA, first of all, you can look it up online. But secondly, if you like having that back and forth conversation with an expert in this topic, I encourage you to pick up the phone and reach out to Aaron and Will, and they'll be more than happy to tell you the difference between both different types of retirement accounts and why a Roth IRA might be a much better idea for you. Lastly, number 5, and this is going to lead us to our next topic, is you got to stay disciplined and always invest based on whatever you're comfortable with. Invest in what you are comfortable with. That is the reason why you should do your due diligence to research things that are out there that you feel comfortable with. Granted, maybe it doesn't apply to those individuals early on that invested in crypto, and before you know it, they became millionaires quickly, but they really couldn't tell you how crypto works. How do I know? Because I had friends that did very well in it, and when I asked them to explain how it works, they really didn't know how. All they know is they were making money. And then I have friends that went ahead and jumped in and decided to invest in crypto, and then a couple months later, they lost just about everything.
Mm-hmm.
Right? Now,
Right.
you have to be very careful with that. I'm not saying it's a bad thing. I'm saying that you have to be very cautious about it. So what do you do? You stay very disciplined. You invest in things that you're comfortable with. You invest with people that you are comfortable with. By us having this platform right here, it's giving you, the listener, an opportunity to hear a lot of the concepts, ideas, a lot of our experience, a lot of our stories that Will, Aaron, and myself have to share with you guys. This gives you an opportunity to get to know us and for you to make a decision to say, you know what? I trust Aaron. I'm going to reach out to him and I'm going to go ahead and ask him some questions about what should I do with my 401k for my previous employer. Where can I move that money? Because I was thinking about cashing it out, and then my sister-in-law told me, don't do that because there's going to be a lot of penalties and you're going to regret it. Do not cash that thing out.
That's right.
And oh, by the way, once you do find your next job, and if they happen to offer you a 401k, set it up as a Roth IRA, not as a traditional 401k. Do a Roth IRA. Why?
Right.
You got to call us to find out. But
That's
there's a huge
right. Okay.
advantage in doing that.
That's
Yeah.
it. Hey,
So,
I love
gentlemen,
that.
so that's my 5. Get rid of your fixed rate broke mentality. Number 2, budget aggressively. Number 3, build an emergency fund. Number 4, invest in Roth IRAs. And number 5, stay disciplined and invest based on whatever you are comfortable with. This is your money, your future. You have control of where that money goes.
Absolutely, absolutely, Oscar. And something you said, invest with who you feel comfortable with. As a matter of
Mm-hmm.
fact, Aaron can attest to this because we've got some clients now
Mm-hmm.
that we're getting ready to do business with, and they said, "Hey, I trust you guys. I
Mm-hmm.
trust you guys." They've been listening
Yeah.
to the show, and they feel comfortable because we are explaining
Mm-hmm.
things that they didn't know. They says, "Well, versus," and I'm paraphrasing, obviously, versus their last broker or agent or whatever. He came and didn't ask many questions and said, "Okay, I think you should have this, or I think you should have that," or they felt pressured
Mm-hmm.
into buying something. And Oscar, you said before, what you like to do when you meet with your clients, that you just don't pull out an application right away on that first visit.
Mm-hmm.
You want to do your fact finding. You want to do your due diligence. You want to find out what this person has in mind, what they feel comfortable with. Okay, what do they want their future to look like? And then you take that information and then you do your research and find out what you think what might work for them. And like Aaron and I, what we've done, we says, okay, these are your two options, and let me explain those options to you.
Right.
Okay, and what you feel comfortable with, that's what we're going to go with. Okay, we can pull out anything. We can sell you a lot of different things, but that may not be what you are really looking for. May not be what you're really comfortable with, and it'll be a shame to come back later and say, "Oh, that's not what I thought this was going to do, or what this is going to be."
Right.
And that's why, Oscar, I'm so glad you're back. And we want to break it down to this simplistic form for those who aren't in the financial industry. Some of the terms that we're talking about, you may not have heard of a Roth IRA before, or you may not have heard many of these terms. So we're here to break it down so it is palatable to you, so you can digest it.
Mm-hmm.
Okay, and it makes sense. We need to make it make sense to you. Okay. So,
Absolutely.
before Oscar give us the recap, Aaron, do you have any questions?
Yeah, well, no question. I just want to comment. Ditto, I guess, from what you said. Yeah, we hearing things from clients about, like I say, breaking it down in the simplest form, being comfortable. And one major thing we are doing, if the client's not ready right now, is okay. That's fine. We're not pressuring them like, oh, well, you got to do this today. No, it's on your time, and we stress that it's on your time. We are here. We're just gonna give you the information. You got the information, and that's it. So I mean, it actually could be next year. When you actually truly ready. But it's no pressure. There's no pressure. We stress that.
Absolutely. What I like to tell my clients, or the process that I walk a lot of my clients through, it's called a financial MRI. Now, the
Mm,
reason that I call that is
I like that.
because
I'm
what I
writing
do is
it
I ask clients, as well as I ask other agents and advisors, this question. If let's say, for example, I'll give you a pretty extreme example. Let's say that you have a migraine, and this migraine has been around for the last couple of days, and you've taken all this different medication, aspirin, Advil, all these different things to try and get rid of it, but it doesn't go away. And it gets to the point where your spouse is just sick and tired of you constantly complaining, and that he or she advised you to go to your doctor to get it checked out in case it's something serious, right? You
down.
go to your primary doctor. Doctor comes into the office and says, Oscar, I understand that you have a migraine that won't go away. And you say yes. And if the doctor was to tell me right out the gate, well, just by looking at you, I think it's a tumor.
Mm.
And I think we should schedule surgery um, in the next few days. Will, how would you respond to something like that? They just looked at me, and all of a sudden they immediately diagnosed me and said we should go into surgery, major surgery, that I may or may not come out of just because the doctor just looked at me. This is the same analogy that I use when us clients are meeting with a professional, quote unquote professional. Let's call it a financial professional since that's what we are. But if they were to come in with us and we just ask them a few questions, and all of a sudden, here's an application, I already know which product's right for you. Do this one. I can promise you this, that would not make me feel comfortable. It's the same
Absolutely.
analogy because it's our financial responsibility, us as fiduciaries, to ask as many questions that are needed for us to really understand what the concerns are for that client, what their primary objectives are, what are their biggest fears. And I know it may take a little bit longer, but the way I do my appointments, I provide some of these questions before the actual appointment because I want my client to be prepared for what I'm going to be asking him or her.
That's right.
And at that point, it's going to keep us on track. We're going to focus on the main things. And it may take 2, 3, 4 appointments before I actually show them something because I really need to understand them. I need to do an appropriate MRI, but a financial MRI, so I can appropriately diagnose what their financial situation is.
It makes sense.
I love it.
It makes sense.
Love it.
And to answer your question, if someone came in, like you said, they didn't do that financial MRI and start throwing applications at me or this type of thing, and they say, well, what do you think about it? I'm gonna say, well, this is a family show, so I'm gonna keep it clean. I'm gonna say no. I'm going to say no, and because I will not feel comfortable because number one, you haven't explained to me what it
Yeah.
what it is, what it's going to do for me, and how this is going to help me secure my financial future. And I'll
Right.
tell you something else. And as an agent, I think that we would be doing ourselves a huge disservice by doing it that way. Because if they feel comfortable with you, they will feel comfortable telling their friends about you.
Mhm.
You see, this is wow. I really like this guy or this lady, whoever your agent is, because they explain things to me, and it made me feel comfortable. And we've heard that before, haven't we?
Yes,
We've
we
heard that
did.
before.
Yes, yes. A lot.
Absolutely.
Yeah,
So
a
they
lot.
have no problems referring you to someone else. But if they're not comfortable with you, they're certainly not going to refer their friends to you. So as
I
an
agree.
agent, you are doing yourself a disservice. So absolutely, absolutely. So there's quite a few things. I like your top five when you talk about that fixed rate and broke mentality, buying useless things. Aaron and I had a conversation with someone about this. I think we were talking about this. Like you said, if you have that broke mentality, and now all of a sudden, you got all of this money in your hand, and like you said, Oscar, it starts burning a hole in your pocket. You go
Right.
out there and you buy the newest and the most shiny thing out there, or that bling,
Mhm.
or those $500 Jordans. Okay,
Mhm.
which you're not going to appreciate. It doesn't appreciate, and you're not going to appreciate those in a year or two.
Right.
And so it makes no sense. It really does make any sense. So where you can take that money, or going out to a club, we talked about this, where you
Mhm.
have a lot of people have a job and they go out on a weekend, they'll blow $100 in a weekend.
Mhm.
Well, that's $400 a month. What if you took that $200 out of the 400 and put it away?
Mhm.
Build your stay disciplined, invest in what you're comfortable with that $200 a month. You know, and you can do that. And as a young person, you'd be surprised how
Yeah.
quickly that will build up,
Mhm.
especially if you have the right instrument that's going to also provide an increase in your investment. So, Aaron.
I can't tell you how many young individuals that I've talked to in their 20s and even their 30s
Uh
that
huh.
have that mentality about they're spending that kind of money. Um, and I showed them a way on how let's invest in yourself first and let's
Mhm.
leverage other options such
Yes.
as an IUL, an index universal life insurance policy.
Mm-hmm.
And let's put some money into this product. And I'm going to show you in 30 to 40 years, granted it's a long time, but I'm going to show you based on these minimal deposits that you're putting in on a monthly basis, I will make you a millionaire.
No.
I'll make you a
Oh wow,
millionaire.
that's
That's aside
powerful.
from anything else that you're doing. Anything
Mhm.
else that you're doing. Just give me that discipline, that $100 a week that you were spending at the club, and let's
Mm-hmm.
reship that money into this. and I will
Mhm.
make you a millionaire within time. And I
Absolutely.
can't tell you how many times it's worked out.
Absolutely.
So it
Absolutely.
doesn't mean that you can't go out there and spend that money, but pay yourself first. Take care of your future, take care of your family, and if you're making good income, go out there and have fun. But you got to
Absolutely.
take care of your future self first.
You do. You have to invest into your future. Go on, Aaron.
And I'm sorry, and that's something too. We mentioned about the club and everything, and the one thing we have to stress to the listeners: we're not saying not to have fun. We're not saying stay in the house for 6 months and save, 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 because we all know human nature. That's not gonna work. That's not gonna work. So that goes back to number two: a budget aggressively. So, Wim, that was a perfect example. You said $100 a weekend. Okay, let's cut back. Maybe I don't have to go out every weekend. Well, I know I don't have to go out every weekend because if you're in certain towns, you're gonna see the same people anyway. The same people anyway every weekend. So, how about this? Maybe as a young person, maybe I pull back to one weekend. One weekend out the month, and then maybe I pull back even more, a weekend every other month. And you will see, and like we said, when you invest the rest in certain tools and sources, you will see a difference. You will see a difference, and you'll be financially ahead of the game.
Right, right, right. Absolutely. And I love it when young adults follow what we're talking about because they have a lot more time. I used to have
Yes.
clients that come in my office, Oscar, and they're uh, 55, maybe 60, and they say, "I need to set up a retirement account." And I would say, "Okay, when do you plan to retire?" "Oh, in about 2 or 3 years."
Mm-hmm.
Well, and then I explained to them, well, and how much are you looking to receive upon retirement? Well, I want this and I want that. I said, well, how much are you willing to put in? Oh, $100 a month. Well, I have to really sit down and explain to them it
Yeah.
doesn't work that way. So it's going to take a lot more time and it's going to take a lot more money. So
Mm-hmm.
that's why I always insist that you start investing when you get your job, when you get your first job. And if you
Mm-hmm.
haven't, and if you're in your 30s and your 40s, okay, you may have to be a lot more aggressive. Like you said, uh, I
The
say
budget aggressively. Yeah.
budget aggressively.
Mm-hmm. Mm-hmm.
You know,
Yeah.
you have to budget aggressively. So now let's talk about some tools and give a recap, Oscar, on some. You mentioned the IUL.
Right.
A lot of people, Aaron and I, we've been talking to clients about a UL. We've also been talking to people about fixed index annuities, which is
Yeah.
my favorite. So
Mm-hmm.
I think now you take someone who is very conservative, and Oscar, you give us your opinion about that. They're very conservative, yet they really want to make some money. I think the combination of maybe an IUL or maybe a UL or even a whole life policy and a fixed index annuity. And you have that that's what you have in your portfolio. Okay. Now you can do some other things, but those to me would be like the bedrock or the foundation of you
Yeah.
building a good sound portfolio. Do you agree with that, Oscar? And
100,
also
100%.
okay. Also, now let's break down a couple of these things. Let's talk about the fixed index annuity and the features, advantages, and benefits of that. Then we'll talk about the features and advantages and benefits of a UL or a whole life or an IUL. Let's talk about that a little bit.
Absolutely. So, William, when it comes to fixed index annuities, the main thing to keep in mind is that this is an insurance vehicle that we are using to put monies into it that will later be used for retirement, specifically for retirement, right?
Mm-hmm.
And there are different types of index annuities. On the last interview that we did together, we really took a deep dive into how those work, all the way
Mhm.
from fixed annuities that are very similar to CDs, to
Okay.
SPIAs that provide an income stream, to fixed index annuities and the income riders that they have,
Right.
and the fact that they can also double your income in case you become sick. Index annuities come in a lot of different ways. And what I can tell you is that there's been a lot of my clients that have been counting their blessings that they own a fixed or fixed index annuity in their portfolio, when we've experienced the market crash over the last several years. We've experienced several crashes in the stock market. And
Mhm.
for a lot of us that can look back at those certain years back in time where our 401ks became 201ks, when the real estate bubble bursted, right? Those experiences are out there, and it will happen again. So we have to be very careful that we don't have all our money aggressively invested in the market, because we are still in the longest bull market in the stock market history.
Mhm.
At some point, it will correct. So by having an index annuity or a fixed annuity, what you're telling yourself is that you don't want to receive these low rates that are in the banks,
Mhm.
but you also don't want to deal with a lot of the risk that the stock market has. You want somewhere
Right.
in the middle.
Right.
That's what these index annuities, that's what these fixed annuities offer you. Which one is the right one for you? That's when I recommend that you reach out to Will, reach out to Aaron, and we'll be more
Mhm.
than happy to ask you those questions. Do that financial MRI and
Mhm.
uncover what's the right thing for you. But you having an index annuity or a fixed annuity in your portfolio, what that's telling you is that you're a smart investor, that
Mhm.
you're not willing to put all your eggs in one basket and put it on the market, put it, go to Vegas and put it all on black and risk it all.
Mhm.
Mhm.
It's saying that you want to make sure that you are putting some money in a safe place that can still grow and protect your future. You're thinking about your future. You can still
Mhm.
invest in the stock market, you still invest in different investments, but first you got to take care of that foundation of your retirement. You got to play it safe. So that's on the index annuity side. And on the fixed annuity side, on our very first interview that we did, we talked a little bit more about life insurance and the
Mhm.
differences between term insurance, final expense, whole life, universal life, index universal life. There's all types of different life insurance policies that are out there. The main thing to keep in mind is that, first of all, the best type of life insurance that you can possibly own is the one that's enforced when you pass away.
Mhm.
That's the first thing. Now, why is that important? Because your family, your beneficiaries, your business partner, because sometimes people get a key man life insurance policy if you're running a business with a partner, but more specifically, your family, if you're getting life insurance for your family, if you're getting life insurance for to protect to cover the mortgage. And sorry about that if you guys hear the dogs barking in the background.
I thought it was, I
It-
thought that was
But
William. I thought that was William.
I don't know if my dogs are happy with my response there, but rest assured that they're going to be financially okay if I pass away.
There you
Um,
go. There you go.
but this life insurance, it's going to go to whoever that is, that special someone, maybe to your church. It's going to go to them to income tax free.
Mhm.
That's a
Mhm.
big benefit. Now,
Right.
the differences between index universal life and universal life, whole life insurance, term, there are some strong differences. By having that appointment with us, we'll be more than happy to, first of all, ask you these important questions to
Mhm.
determine what you're looking for, what type of life insurance, or what's your budget like? What are you comfortable with? Because last thing we need, first of all, is as you're budgeting aggressively, that we come here over the top and stick you with a life insurance bill that you're not comfortable with, that you're not going to pay for the long haul. You might cover it for the
Yeah.
first 3 months, 4 months, but then after that, you're going to say, Oscar, I can't afford this because I
Mhm.
still have to do all these other things. That's the reason it's important to do that financial MRI. We need to see what makes sense to you, but is also comfortable to you. It's not adding additional stress. But term insurance in its all simplicity, it's just a nice, affordable life insurance that we can pay pennies on the dollar that can pay out a significant death benefit to your loved ones. When we're looking
Mhm.
at permanent insurance, which is whole life, universal life, index universal life, now you're taking it a little bit more seriously. Now you're saying that you not only want to make sure that you're able to provide some form of death benefit to your loved ones, but you're also saying, what about me?
Mhm.
I want to build some cash. I want something that's in it for me as well. I
Mhm.
want to be able to grow some cash value within this vehicle. That, let's say, for example, I get to age 65, I get to age 70, and the house is already paid off. So I already know that my estate's going to receive this property.
Mhm.
But I realized that maybe I didn't save enough money. Maybe my
Mhm.
401k did take a big hit. Now I have the option, if I have a whole life insurance policy, if I have an index universal life policy, if I have a universal life policy, where these types of life insurance contracts build cash value.
Right.
And I can go to the insurance company and say, I have this cash value. I want to see if I forego the death benefit, because again, my mortgage is paid off, my children are grown, they have their own children, they're financially okay. But my wife and I need some money to live off of, some additional financial support. I can now convert that cash value in a life insurance contract. Get this, convert it into an annuity within the contract. So it's not a separate contract. It's still an annuity to go ahead and fund me my retirement for me to get additional income while I'm in retirement for the rest of my life. That's what
Mm-hmm.
these life insurance contracts could do in the long haul. That's what's in it
Yes.
for me. But I don't have to wait for retirement. Many of my clients, especially with whole life insurance, they'll leverage that whole life insurance to take out loans early in the contracts to reinvest into their business, to go ahead and pay for the new roof that they need in their house, to
Mm-hmm.
pay down their debt. When I talk about budgeting aggressively, I show a lot of my clients how I can help them do that by investing in a whole life insurance policy and coming around and leveraging other people's money. When I say other people's, the insurance company's money,
Yeah. Mm-hmm.
to pay down my debt, to put me in a better financial situation. I mentioned during that very first interview that I show clients how I can pay off their debt in 9 years or less, including their mortgage, without spending any additional money. That's what I'm
Mm-hmm.
able to do for the right clients. To find
Absolutely.
out if you're a good fit, you got to reach out to us, and we'll be more
Right.
than happy. No obligations. We'll respect
Yeah.
whatever decisions you make, but we
Right.
will educate you. We will
Mm-hmm.
put you in a better financial situation by the information we have to share. And at the end of the day, going back to the top five that I talked about, you got to invest based on whatever you're comfortable with. And if what we showed you brought some comfort to you, we're hoping that you move forward with us.
Absolutely. Got a question for you to break it down, and I want you to break this down to the audience because you said something extremely important. I've got this policy, this permanent policy, and I've had it for several years, and I've built up all of this cash. The mortgage is paid off, my children are okay, and I still have some insurance left, and I can convert some or all of that money that's in that cash into an income stream for me. Now, I and listening to that, you are speaking of what we call a guaranteed lifetime income product that you can find or in an index annuity. Is that what you're speaking of, Oscar?
Um, yes. Um, there, in certain circumstances, what we can do is we can take this cash value in a life insurance contract
Mm-hmm.
and do a 1035 and move. That's the insurance term 1035. That cash value into an index annuity, and at that point provide an income stream.
Right.
What I do with most of my clients, no different than I'm working with a client that just retired from their job and they have a 401k.
Mm-hmm.
The 401k plan administrator or the company that houses that 401k, they're going to go ahead and offer you an option. They're going to, or even if you have a pension, they're going to say, you know what? Now that you're retired, you can go ahead and begin to start taking an income stream.
Mm-hmm.
I always ask my clients to ask for a quote on what that income stream is going to look
That's
like.
right.
Good.
Take a look at
Mm-hmm.
those numbers. Let's keep it real. I'm not here to
Mm-hmm.
tell you all these things that are going to impress you. At the end of the day, what you're going to remember, what you're going to take away is how much money hit my bank account.
Right.
Mm-hmm.
That's what people are going to remember. It's
Of
what's
course. Yeah.
actually hitting your hand. So what I want is I want you to give me that Pepsi challenge. I want you to get a quote from your current plan administrator,
That's right.
get a quote from your current life insurance contract. If you have
Mm-hmm.
cash value within the contract, let's get a quote. It's called an in-force policy illustration. Let's
Right.
get a quote from the insurance company. Once we get that quote, now we're going to take a look at, let me see if I can put you in a better position on a guaranteed basis. I'm
Mm-hmm.
not dealing with if the market does well, I can get you more. That's not what I deal with my clients. I offer predictability. I offer guarantees. If I
Mm-hmm.
can guarantee you with an A-rated insurance company that I can surpass the amount of income that your current life insurance policy is offering you, that your current 401k plan administrator is offering you, whoever you have your pension with, whoever you have your 403b plan with. If I can show you that I can offer you more, can I earn your business?
Mm-hmm.
Because at the end of the day, what I love about math is fact. It's not fiction.
Right.
If the numbers are adding up and I'm giving you more, significantly more, can we move forward? In most cases, the answer is yes. In most cases.
Absolutely. And it's just about all cases, we can offer them a higher income stream.
Yeah. Mm-hmm.
Yep, absolutely. Now, what happens if they say, "Well, my job offered me this. I think I'm gonna do this," and they what they call I would call it annuitize the contract. What happens when that money runs out from the job? And does that happen? Does the company guarantee you that you're gonna have that money for the rest of your life? Or yes, yeah, you shaking your head. I'm glad. I'm glad. And this is the reason why I'm asking the question. So let's say I've got $300,000 from the job, and I'm getting an income of X number of dollars from the job. Once that 300,000 runs out, then it's over. Am I correct?
Right.
In
Okay.
most cases, it is.
Okay. Versus what we can offer, you, myself, and Aaron, what we can offer is a guaranteed income, the same $300,000, and plus we're gonna give them a higher income stream, and it is guaranteed for the rest of their lives.
That's your life.
Okay,
Mm-hmm.
even if they surpass the amount of money that's in their account. Am I correct, Oscar?
You are correct. And we can even do it to the extent where we could do a joint payout for a couple. For the rest of both of their lives, we can do it that way. We can set it up in some cases for business partners. We can do that as well.
That's outstanding.
But also, in most cases, 401k plan, when you do take an income stream, what it does not have is features such as if you become ill, if you become sick, will they double your money for up to 5 years? The answer is no, they will not.
That's right.
That paycheck will continue to come as long as there's money in the account.
That's right.
What we're offering you is income for the rest of your life, no matter how long you live.
That's right.
Depending on the insurance company that we choose, they'll double your income for 5 years. I can't tell you how important that is, gentlemen, because again, the number one thing that I've seen crippled so many families is financial position. Is one of them somebody in the household getting sick.
Right. Yeah, and that's where I was going to touch on, because if we go back to that 401k scenario from that job when the money runs out. So if you have X amount of dollars that's sitting there, say 100,000 still left, you become ill. You may need caregivers, or you may have to go to a home. That's it. That they pulling from that 100,000, they pulling from your assets, all of that. So that's it. When that runs out, it runs out.
That's right. And like you said, and if you do get sick, it's going to run out a little faster. Oscar, you said something, and we missed what you said. You mentioned something about, and I believe you were going to say, if you became ill, then we can double. Let's say you get $20,000 a year. Okay, for 5 years, you become ill. We can double it to $40,000 a year for 5 years. Is that correct?
That is correct. And
Okay,
we'll, after that 5 years is done, it
it
goes
goes
back
back.
to 20,000 for the rest of your life. Granted, at that point, the high probability is that your account went to zero because you're taking out so much money out of the account. But this is a contract with an A-rated insurance company that says you'll continue to receive that guarantee of $20,000 for the rest of your life.
Absolutely.
I can't tell you how important that is for me, how important it is for my spouse and I to know that we have that extra financial security built into our plan, the foundation that we were talking about early on.
Yeah.
And now I can't, and if I have a mutual fund account, now granted, the mutual funds are okay for the right people; it's the right fit for you. But you cannot do that with a mutual fund account, can you, Oscar?
No, you cannot. It's one of those things where you're taking some risk. The reward is that you can probably double your money rather quickly if you're fortunate enough and you invest well. But the trade-off is that you can also lose your money. It's the same thing, and I don't mean to say it very aggressively, but it's almost like you are going to Vegas. Now, if you're a good investor, there are ways on how you can hedge your account, your mutual funds, your stocks, uh, in order to better protect you. Granted, if you're working with a broker, there's going to be a fee. In
Absolutely.
most cases, for me, there's no fee. I don't charge a fee for my services,
That's right.
right? The if you do become ill, there first of all, mutual funds don't offer you a lifetime income.
Right.
They can't.
Secondly, you might be saying, okay, well, I'll cash it out. I put $100,000 in a mutual fund 6 years ago, and I became sick, so I'm going to cash that thing out.
Right.
Well, the question you should be asking yourself is, 6 years from now, how much is in that account?
Yeah.
We
Right.
don't know. We
Right.
don't know what's in that account. We're at the mercy of the market. It's going to go up. It's going to go down. We don't know what that value is going to be, and whatever that value is going to be at the end of 6 years, when we really need it because we became sick, not only are we cashing out a question mark of a dollar amount, but we're also paying taxes on all of it.
That's it.
Yeah.
So
Yeah,
we have
that's
to
a
be
big
very
thing.
careful with that as well.
Absolutely. 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 And again, going back to your permanent insurance, you can take money out there, and in most cases, tax free. Tax free. You can take it out because you are borrowing that money from your own policy, and there's no taxes on a loan. There are no
Correct.
taxes on.
On life insurance, that's how we
Right.
do it, by using life
Absolutely.
insurance. One of
Uh,
there's a lot of wonderful books. As a matter of fact, one of the books that I was going to recommend, if your listeners reach out to you guys,
mhm.
one of the books does have to do with life insurance and how the rich become richer. The best way on how to leverage other people's money.
Mhm.
And one of the biggest chapters in that book is life insurance.
Right.
Right.
Life insurance is
Right.
such a key.
It is such a key. And give you an example, I have a client that lives in Lake Arrowhead, California. I think I may have shared this story with both of you. And he has five $1 million policies, whole life policies. And he owns a real estate company. And up there, it's seasonal, meaning that sometimes his business is booming and sometimes it's slow. And he's called me before and says, William, I need $25,000. Okay. And we were able to get it out of one of his life insurance policies because he had built up cash in that policy. And he has two on himself, one on his wife, one on his daughter, and one on his son. I mean, what a smart way. There was a book out a while ago called Be Your Own Banker. I'm sure you've read that one too.
Yeah.
Yes, sir. I've read that book as well.
Yeah. Me too.
Yeah, absolutely. Be your own banker, and it's an amazing book. And see, but life insurance. When someone talks to you about, especially professionals like us, when we're talking about life insurance, we're not talking necessarily about death insurance.
Mm-hmm.
We're talking about living insurance, meaning that you can utilize these and have so many benefits while you're still alive. And that's why it's such an important thing. If you're building a portfolio, again, I'm going to say this again, and you want to build it safely, it's okay if you have a mutual fund account, but don't put all of your eggs in that basket.
Mm-hmm.
Okay, I would have myself a fixed index annuity. I would have a permanent policy, and I would have maybe a percentage of that in a mutual fund if I still want to be aggressive. But keep in mind that foundation is going to be on between that life insurance
Right.
and that fixed index annuity. Now you can also go with what Oscar said, a fixed annuity. They are paying more now than they for several years. I remember going back some 20 years ago, maybe a little bit longer. Man, fixed annuities, they were paying fixed. I'm talking about fixed now. A fixed annuity is an account. There's no cost to it. There are no fees to you at all. You put it in there, it'll pay you a certain amount of interest. A fixed, that's why they call it a fixed account.
Right.
And fixed annuities at that time were paying 6.5%.
Mm-hmm.
They were paying 6.5. I mean, it's crazy. Then when uh, uh, inflation and a couple of things kicked in, and years later, then it started dropping. And so now it's back up. I think the going rate right now, Oscar, is between 4 and 5 in most cases.
Mm-hmm.
And with some companies, I believe it's
Mm-hmm.
up there.
That's correct.
But and with the index annuity, it's a lot more aggressive. You can, and you've said something that I cherish, Oscar, and that is that with the fixed index annuity, you have market. Let's see, you mentioned something about you have the market type of product without the market risk. I'm paraphrasing. You can phrase it better than I did because I love the way you phrased it. You
I
have
believe I
the
said you can
The
get
market
stock
gain, yeah,
market like returns
right.
uh-huh.
without the downside risk.
Yeah.
Absolutely, absolutely. And when we start talking about fixed, and let's break this down a little bit. Okay, if you have a fixed index, so we already explained to you what a fixed product is. Okay, there's no risk at all. You know, you're going to get what the company has offered you. Well, we also now with the fixed index, you get the market like returns.
Mhm.
But the only thing about it is that if the market goes down, you still do not lose what you have.
Right.
And what I really love about it also, it has a reset, annual reset feature in there. So you have $100,000, and let's say I'm gonna just throw this out, and let's say it goes up 10%. Now you have 110. All right. So and the anniversary say is up 10%. Now you have $110,000, right?
Mhm.
Let's say next year the market drops a little bit or drops completely, and then you still have your $110,000.
Mhm.
You see, so the risk is on the company and it's not on you. And these products, we like Oscar said, we don't charge you a fee for our services.
Right.
We don't charge you a fee. But if you have a mutual fund account, you're going to pay a fee for that. Even with the variable annuities, now that's in the stock market. I mean that is you. That's a risky thing there. Okay, you pay a fee, and some of those are high as 1.5, 2. And I remember one company I worked for, the fee was 2.35%.
Mm. Ooh.
Now think about that, and you're going to pay that every year, whether you make money or and or lose money or
Mhm.
not. If you make money, you're going to pay the fee. If you lose money, you're going to still pay that fee.
Mhm.
So we're talking about solid product. I can't believe we are out of time, gentlemen. What happened? Hey, Oscar, any last thing you want to share with the audience before we exit?
Yes.
Um, yes, what I'm going to say is this being our third time that that I've had the privilege of being on the show with you gentlemen. Um, I would encourage your listeners, if they're still watching this episode, which I hope they are because they're getting something out of it, is it's good to get some information and to raise your financial IQ, to be more aware of how smart money works.
Mhm.
But
Mm-hmm.
it's also just it's even more important to act, to do something about it. What you have here is you have some individuals that have been doing this for a very long time, and we are here to show you what we can do, how we can help you out, to do a thorough financial MRI, and for us to then give our recommendation when it's appropriate. And when we do give you a recommendation, it's our job to make sure that you understand it completely. We're not here to overcomplicate it. We're not
Right.
here to give you all this knowledge flex on you to show you all these different financial terms that uh, that just don't make sense. We're here to
Mhm.
keep it very simple, making sure that you understand what it is that we're recommending, or we don't move forward,
Mhm.
and we respect whatever decision you make,
Exactly.
regardless if it's moving forward or not. So we're not here to give you any pressure, but what you have to do when the timing is right, and when is the timing right? Now. Send out an
Absolutely.
email, put out a call, schedule an appointment, whether it's by Zoom, whether it's by phone, whether it's in person. Schedule the appointment. Since we're not charging a fee, give us the opportunity to find out a little bit about your financial situation, as much as you're comfortable with sharing with us, and
Absolutely.
then we'll see how we can help you out.
And before you invest, just invest a little bit of your time and listen to us and see if it makes sense to you. And we contact Aaron, your number,
804-292-9034.
and you can contact me. That's 909-910-0265. Oscar, it's been our pleasure to have you on, my friend.
Always, always.
And